Welcome to International Securities Exchange's podcast series. Facilitated by renowned educators, ISE podcasts are intended to teach beginning as well as seasoned investors the ins and outs of trading. To find an updated list of podcasts, please visit www.ise.com/podcasts. Please be sure to listen to our important message following this episode regarding the risks of investing in exchange-traded options.
Very powerful strategy if you want to take a long-term position in any one of these pair values, whether it's to the upside or the downside, the same strategy applies. You want to take a long-term view, and you want to offset your cost. Option premiums are expensive. Write the near-term options at the higher strike prices where you believe the pair value is going to trade towards but not above, and just look to collect those premiums on a month-to-month basis. Okay.
So how about if we do it on the CDD? Because I think you said that your focal zone or your focal area was 133. Is that correct?
We've got that in play. Yeah, exactly. Right now, over the next little bit. So I don't have any of the option values, but I think
I have them in front of me.
Okay, good stuff.
127. Now these are long-term options. These are 5-monthers, but we can always roll out of them, as you said.
Okay.
But we buy, let's say we're assuming that the U.S. dollar would continue to rally.
Okay.
You buy the 127 for 579.
Okay, so the 127, let me just go back up in here. So the 127 is 5, okay, is 5, what's that, 20, what'd you say, 9?
579.
579, okay, sorry, guys.
You sell the 133, which you think could be a resistance area.
Yep.
You sell the 133 for 345. Now, these are, literally, they're 5-month options. So there's a lot of time left. But Jason can go through the similar math, and you'll see the power of selling that 133 strike call for 345. Do you mind just going through that again, Jason?
No, absolutely not. So what you've essentially done, right now we know that if we sell that position, that particular spread right there, we have the ability to essentially make $6. All right, is that fair as my math? It's Sunday night. It's been a busy weekend, so but
good to me.
We have the ability to make $6. Well, paying $5.79 is might be an expensive proposition, but all of a sudden, if what we do is we take that premium at the 133 and we apply that to this, we've lowered our cost by what do we have here, Steve? I don't even have
234, I think.
234. All right. So now all of a sudden, we've reduced our risk exposure down to $2.34. Okay. Yes, we've limited our upside potential, but we can now make, if we trade towards this 133 and above this 133 level in the next little while, we have the possibility of turning this, I got to find there it is, this $2.34 into a $6 profit, which represents just over a 100% return on our investment. Now, let's say again, this scenario is that here's your 5-monther, but this is now a near term. You're not going to get 335, but you're going to offset the cost. It may not be down to 234, but you're going to offset that cost maybe down to $4 or so on and so forth. But you can continue again to write these higher strikes as each one expires. Write a new strike. Okay, you might want to go in and say, okay, 140 is the next level, and 160, and heaven help us Canadians when we're trying to do business with you guys in the States. But whereby we're looking at just again collecting these premiums, options expiring, putting that against our initial cost to ultimately offset this to the extent that we have the ability to control or sell buy the CDD at 127, and we have now the possibility to sell it at 160. I guarantee you, this $5.79 is going to be worth, well, 60 minus 27 is essentially 33, I believe. Again, my math.
Yep, that sounds good.
That might be right. So again, this premium here that you bought for the long term, that you paid $5.79 for, that you've offset the costs, should have an intrinsic value of about what would we look at here, from 127 up to 160, of about $33, if I'm not mistaken. Is my math right there, Steve?
Yep. If Canadian goes to 160, is that what you're saying?
Yeah.
Yeah. That sounds right. About 33 points.
So 33.5
actually, but
yeah,
okay.
yeah. So there you go. So again, what we've done is we've just taken our bigger picture outlook. We've bought an option that reflects that bigger picture outlook. We've given ourselves lots of time for that to take place, and to help offset our risk exposure every month, we're collecting a premium, some of these high vol premiums, to offset that, to ultimately lower our risk exposure on a month-to-month basis just in case we're wrong, but again, lower the amount of capital that we've had to put up so that we can make that higher rate of return as we trade. Now, I'm not saying it's going to 140. I'm not saying it's going to 160. But if you believe in a bigger picture, stronger U.S. dollar, then this might be a scenario using a calendar spread that you can apply in your portfolio to help take advantage of this.
Hey, Jace, Carl has a question about the different implied volatilities for the different months. Do you mind commenting on how that sort of plays out? That probably, or quite possibly, you're going to see much different volatilities from, let's say, a 1 month to a 5 month.
Yeah, well, absolutely. Generally,
your benefit.
Yeah, I was just going to say, generally, your longer-term options have a, and again, I mean, correct me if I'm wrong here, Steve, with the way I'm explaining it, but will have a lower volatility in the sense, and such that with your near-term options, the volatility tends to be priced in and be a larger component of that option premium. So you can buy a longer-term option that has a lower volatility and take advantage of those short-term high-vol options to offset some of the costs. So a lot of times you'll see your short-term options. We're noticing this very, very regularly in put options when we're looking at the equities market, that, you know what, it's almost just, it costs a nominal amount more to buy an option that gives you more time because the near-term options the volatility is so high. So you could take advantage of buying those longer-term options. Yes, a little more expensive, but you're not paying for as much volatility and selling the near-terms to take advantage of it.
That's exactly right. The biggest risk, Carl, when you're doing these calendars is that you're really, really wrong. What I'm saying is that, whatever calendar you put on, you buy, the 4 month and you sell the 1 month. If the underlying exchange rate moves dramatically, let's just look at the Australian dollar, right?
Yeah.
Maybe put this calendar on trading at the 115 strike because, again, I think most people thought that 115, at least in retrospect, was probably a level that the dollar against the Australian dollar was going to trade at for a while. At least that's what I've read. Well,
yeah.
Obviously, that prediction was really, really wrong. But if you bought that calendar, the 115 calendar, you got hurt because now that it's up near 160, well, the 115 calendar, remember, the calendar is going to trade at its maximum point at expiration if it goes to the strike price that you're long. So if you buy a 115, you want it to stay at 115. If it goes to 160, basically whatever you paid for that calendar is basically worthless. So that's the point, Carl, is that, as Jason pointed out, the best part about it is you get to sell a higher priced short-term option.
Yeah.
The problem is,
sorry,
I'm sorry.
No, go ahead.
But the problem is that you may, if it gaps so quickly, you can't sell any other options against it, and you will lose most of the debit that you paid.
Thank you for listening to our podcast. To find more podcasts on options, stocks, alternative markets, and market data, please visit www.isc.com/podcasts.